gold and silver have been superstars in the market lately, and here are 5 mining companies that are hoping to ride that precious metal wave. Hold on to your seatbelts, folks. This is going to be a good one. As inflation hangs on and fears mount over tensions in the Middle East, many investors are turning to gold, silver, and other precious minerals as a hedge against the perceived market uncertainties. Personally, I am not that pessimistic on the market, and if anything, with uncertainty becoming an almost normal thing nowadays, the market has done exceptionally well to price in that overall uncertainty. Of course, those investors who are hedging their bets are creating an investing opportunity in the companies that mine those precious metals that they are stockpiling. Costco, who has gotten in on this precious metal demand, is unable to keep their gold and silver bars in stock. The Canadian Costco is also selling gold and silver coins just to feed that demand even more. If this trend continues, it will be great for those mining companies we are going to take a look at today. Join today's conversation. Let me know in the comments if you have a favorite mining stock. Thank you for your participation. If you love this sort of content, be sure to subscribe for more, and another huge thank you for that click. For today's list, I was looking for mining stocks with a positive year-to-date total return. In fact, that's how I sorted them for this list. I was not really concerned with dividends, though most of them actually do have some. I also wanted a positive return on equity, and the stock needed to have a share price over $4 just to keep the penny stocks at bay. So without any further ado, let's do this. Kicking off this list, we have Alamos Gold with a ticker of AGI. They are based out of Toronto, and they engage in the acquisition, exploration, development, and extraction of precious metals, primarily gold, in Canada and Mexico. Their current price at time of recording was $20.97. They have a market cap of $8.34 billion, and their beta comes in at 1.05, meaning they are pretty much right on par with the volatility average of the market. Their earnings per share comes in at 0.73, and they have a price to earnings ratio of 28.73. Their return on equity, that comes in at 7.44%, and they have a debt to equity ratio of 0.04%. That's pretty awesome. That's almost no debt. Little debt, but almost no debt. Looking at their dividend, their yield comes in at 0.645%. It is a quarterly dividend paid out in the amount of 2.5 cents USD per quarter. Their payout ratio on that, 18.87%, so no concerns with sustainability. Switching over to the returns, their 3-year return on investment, that comes in at 96.16%. Factor in the dividends, we get a total return of 98.97%. That's not too shabby. On the 1 year, the return on investment comes in at 17.81%. Adding in the dividends, we get a total return of 18.37%. Year to date, that return on investment comes in at 17.22%, putting in the dividends 17.36% on the total return. That's a pretty great total return to be starting off this list. Alamos Gold may be considered a good investment due to their diversified production from stable North American mining operations and a strong portfolio of development projects, which may provide, well, future growth potential. You gotta like that. Coming in at number 4, we have Teck Resources Limited with a ticker of TECK.A. They are based out of Vancouver, and they are Canada's largest diversified mining company. So they're basically engaged in the mining and mineral development of steel and copper products. Wait a minute, I thought this was about gold miners. Well, yes, it is. They also sell their secondary products, which include both silver and gold. Their current price comes in at $66, and they have a market cap of $34.20 billion. Their beta is a little more volatile at 1.44, and they have an earnings per share of 4.64. Their price to earnings ratio, that comes in at 14.22, and they have a return on equity of 8.52%. Their debt to equity ratio, 39.21%, so they do have a little bit of debt. Looking at their dividend, they have a yield of 0.758%, and that's a quarterly dividend of 12.5 cents per share. Payout ratio on that, 21.55%. So once again, very sustainable. Looking at their return on investment on the 3-year, that comes in at 101.90%. Factor in those dividends, we get a total return of 107.48%. That's pretty good. Now, on the 1 year, and this one's going to be a little bit of a shocker, their 1-year return on investment comes in at negative 34.88%. Factoring in the dividends, we get a total return of negative 33.77%. Holy banana bread, what happened? This does look bad. But it just so happens that the 1 year lines up with a significant peak in their chart. So this value, well, it really needs to be taken with a grain of salt. On their year to date, that return on investment comes in at 20%. Add in the dividends, we get 20.23% for a total return, and that's not too shabby. The company's strategic growth projects and robust financial performance make it an attractive option for investors looking for exposure to essential resources. Taking our third spot, we have Dore Gold Mines Incorporated with a ticker of DNG. They are based out of Montreal, and they are primarily engaged in the processing of gold ore that they're purchasing from Peru. Their current price comes in at $4.97, and they have a market cap of $181.52 million. Their beta comes in at 1.15, and their earnings per share come in at 0.53. Their price to earnings ratio, 9.38, and they have a return on equity of 17.74%. Their debt to equity ratio, 0.71%, so that's pretty darn good. When it comes to dividends, they have a yield of 2.818%, and these guys are actually monthly, 1.2 cents per share per month. Their payout ratio on that comes in at 22.98%. Looking at their returns on the 3-year return on investment, we get 99.60%. Factor in the dividends, we get a total return of 112.37%. On the 1 year, that return on investment comes in at 60.32%. After the dividends, we get a total return of 64.45%. Looking at this year, on the year to date, their return on investment comes in at 24.25%. Factor in the dividends, we get a total return of 25.45%. This is a company that might be considered favorable when it comes to investment, basically because, well, they have a unique business model that supports the artisanal mining sector, potentially offering a stable income from gold processing amid varying market conditions. In our almost top spot at number 2, we have Ivanhoe Mines Limited with a ticker of IVN. They are based out of Vancouver, and they are engaged in the exploration, development, and recovery of precious minerals, including gold, silver, platinum, and other non-precious minerals like copper, nickel, iron, and cobalt. Their current price comes in at $18.36. They have a market cap of $23.30 billion. Their beta, basically twice as volatile as the market average at a 2.01. Their earnings per share, that comes in at 0.36, and they have a price to earnings ratio of 51. That return on equity, that comes in at 9.43%, and they have a debt to equity ratio of 18.08%. This is the one that does not have a dividend. It's the only one on the list today, but they have no dividend. Their 3-year return on investment, that comes in at 110.07%. Their 1-year return on investment, 46.76%. And year to date this year, their return on investment comes in at a nice looking 44%. Let me tell you, these guys could be a compelling investment due to their significant presence in resource-rich regions, and they've got that focus on essential metals that are needed for a low-carbon future. So that's not too shabby. It's a good place to be. In our top spot at number 1, we have London Mining Corporation with a ticker of LUN. They are based out of Vancouver, and they are a diversified Canadian base metals mining company that primarily produces copper, zinc, gold, and nickel. Their current price comes in at $15.62. They have a market cap of $12.11 billion. Their beta fairly volatile, coming in at 1.85. Their earnings per share come in at 0.42, and they have a price to earnings ratio of 37.19. Their return on equity, that comes in at 5.32%, and they have a debt to equity ratio of 23.15%. Switching to dividends, they have a yield of 2.305%. It's a quarterly dividend paid out in the amount of 9 cents per share. The payout ratio, a little bit higher, 85.62%, but it's still sustainable. On their 3-year return on investment, that comes in at 3.44%. Factor in the dividends, we do get a total return of 10.40%. They did slide a little bit in the beginning of that 3-year period, so it doesn't look that impressive when you look at that big scale. But once we switch into the more current timeframes, like the 1 year, that 1-year return on investment comes in at 45.03%, total return of 48.38%, and this year, year to date, that return on investment, 45.71%, total return of 46.55%. London Mining could be a pretty good investment due to their strategic operations across various geographies and commodities, which of course, that diversifies their risk quite a bit. The company's strong focus on sustainable mining practices and robust financial health may actually appeal to a lot of investors looking for ethical and profitable opportunities within the mining sector. So definitely a good one. Once again, These are some great looking companies to get some solid exposure into the material sector. And while gold and other precious metals are expected to have a good year, so should these stocks. If you are interested in any of these stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on Pamina pipelines, and I will see you in the next video.